advising clients across the country. Here he is, your host, J. Christopher Boyd.
Welcome back to Hour 2 of Something More with Chris Boyd. My name's Jeff Perry. I'm sitting in for Chris this week. And for this hour, we have one of my favorite guests, and I know your favorite guest too, Brian Regan, our Chief Investment Officer. And Brian,
I'm flattered.
Well, I find we do a lot. It's something more that shows something more. And Chris has done a good job recently of talking about why we bring on various subjects at different times. But foundationally, I think people listen to the radio, a financial show, from a group of financial advisors and certified financial planners and analysts like you for financial topics. And you have the education, experience, wisdom, whatever words we want to use to, be an expert in a lot of the things that our listeners are thinking about. So I know that I get feedback from most of the shows that we do, and people like to hear your insights. I get messages back that they don't agree with you sometimes, which is good. Meaning, I'm glad that people feel free to share their opinions. I love getting opinions if I agree with them or not, but they're listening, and that's what makes a market, right? If everybody agreed, the market would go one way or the other all the time, and as we know, that's not how the market works. It's full of different opinions, different outlooks, different predictions, different analysis. So
that's super interesting, and I would love it if you shared some of the disagreements, because I do make a active effort to mostly give people the facts. I do inject my opinion here and there, but a lot of the things I hope to say aren't really arguable. I'm just trying to tell people how it is, and sometimes how it is in contrast to public opinion or social media or whatever is on the news, or even what would seem to be common sense. That's kind of how the markets work sometimes.
Absolutely. And maybe I'll start writing these things down, because they just usually come in as a text or a Facebook message after the show, and then we can maybe make an episode of them.
Yeah, we'll follow up on them or do something like that. Be great.
That sounds good. So, when I was preparing for this show, I'd take some notes and prepare a draft agenda for our producer, Armin. And there's way too much stuff on the agenda. So we're not going to get to it all. So I want to start with a report that came out Thursday, a couple of days ago, GDP, which is, and I know it's not the be all to end all, but it is something that gets the news, right? Gets people thinking. It's reported on their evening news. It's reported on the front page of CNBC on that day. It's something that the media likes to talk about. So the report for this last Thursday said gross domestic product, GDP, rose at 1.1% annualized rate for the first quarter, and that was below an estimate of 2%. It said that slumping inventories and a general decline in private investment has held back this number. So what do you think? So people are worried about recessions, people are worried about a slowing economy, which we're going to get into corporate earnings, which is, certainly related to all of this. When you saw the GDP number, what do you think?
My initial reaction was probably good news for the markets.
Mm-hmm.
I would expect this to keep a ceiling on longer term rates, and that should generally be good for the stock market and the bond market for that matter.
So
that was my initial reaction.
So maybe for listeners who haven't heard our more in-depth conversations about that, it might sound a little bit counterintuitive to them, because it's not great economic news, but you said it might be good for the market. Explain that a little bit, how that works.
I think this is this interestingly dovetails with what we were talking about before, where
right.
The things I'm saying, I'm trying to give the facts on the ground, but
right.
might be the opposite of common sense.
So a listener could say, I could get a message, hey, did you see GDP? Maybe I should get out of the market, right?
Right. You and I both know that I would never take one reading of GDP and say get out of the market.
Right.
We preach the long term to start. So a couple of things. The stock market is priced on earnings and interest rates. I say that as often as possible because I I really mean it. It's kind of finance 101. It's probably one of the first, 5 things that you learn when you walk into to business school. And I think it often gets forgotten, right? I think people either concentrate on one thing or the other. And in 2022, we were very concentrated on interest rates. In 2023, it seems like people have forgotten about interest rates and only care about earnings. So the reality is that we're going to talk about earnings in a little bit, but the Federal Reserve wanted to slow down the economy, which is why they were raising interest rates. And why did they want to slow down the economy? Well, obviously inflation, but GDP readings are real rates. So that excludes inflation. And in Q1 of 2021, we were at 6.3%. Q2 of 2021, we were at 7%. Q3 of 2021, we were at 2.7%. And Q4 of 2021, we were at 7%. So those readings are off the charts. So when we talk about the economy slowing, it's certainly slowing. 1.1% from 7% is certainly slowing. And that could give room for the Federal Reserve to stop being so aggressive, which should keep a lid on longer term interest rates. And remember, as rates go down, it's usually good for really all assets to go up. Higher longer term rates is like gravity for risk assets.
Very good. And so so this is still growth though. This is still positive. It's still a positive number. And so why are folks thinking, or why are the headlines, I guess, keep using that word recession when we haven't even had 1 quarter of negative growth?
I don't know.
Yeah, that's a good answer though.
We talked a lot about how people tend to just report whatever they think will get the clicks or the ears, or
right.
I think we've seen a lot of that recently with some high profile firings for obvious lies happening on certain networks to keep an audience. But if I were to venture a guess, the economy is certainly slowing. That is the intention of the Federal Reserve. We've been hearing this for how many months now. I think politically it's expedient for half the country to even root for a recession, and politically for the other half of the country not to want a recession. And the way I look at it, quite frankly, is I don't want a recession anytime ever.
Right.
It's the reality that I think of. But you're right. These numbers aren't bad. 1.1% growth, less than expected, but still moving in the right direction. And that's also coupled with much more tolerable inflation numbers that we're seeing these days. So, we should, as investors, we should think about looking forward. These numbers are looking back. So yeah, we're slowing from a really excessively high rate. But we're not in a danger territory. When we talk about GDP, it's hard not to talk about employment, and personal expenditures. And personal expenditures did fine in this report. This was more about business investment. That basically means businesses being more cautious, pulling back on their inventory build a lot of the time.
In a couple minutes, we'll talk about some earnings. But one of the things that I've been hearing, since you brought up the consumer, and personal spending, the earnings reports that I've seen, the CEOs are saying that the consumer is still there. They're still participating. They're still engaged. They're still, flying. They're still going on vacation. They're still consuming most products, as maybe above expectations for some people.
I don't think that's not surprising to me either. Don't we know that Americans will spend until their last penny? This has been like a truth in the economy ever since I can remember. And, maybe better than I do, but, that seems to be true. And the reality is, unemployment is still very low. I mean, people have jobs. People are still getting decent raises. I mean, lower than they were getting a year ago, but still decent raises, still decent wage growth we're seeing in the economy. So no, that's not surprising to me either. When that switches, that'll switch like a light switch. That's not going to be a gradual change. I think what we're seeing right now is businesses being more cautious, in anticipation of that possibility happening.
Right. But it hasn't translated to the consumer, at least as far as I've seen in the housing market, at least the ones that I watch and, kind of the general numbers is not showing significant, it's coming off the peak. Certainly. It's not what it once was. It's more of I call it a normal market where if something is priced fairly, it sells. If it's overpriced, it doesn't. And if it's underpriced, it's gone tomorrow. So I'm getting more optimistic in my outlook for the next 6-12 months than I was, I guess, a few months ago.
Yeah. Well, one of the things that I've been noticing, and I think we all need to be careful not to fall into this trap, is that when the market tends to be going up, everybody starts to get excited. When the market's going down, we all get nervous. And to the best of your abilities, we should all actively try to do the exact opposite, and that's a very hard thing to do. But that's what we should all be striving to do. If you just look at 2022 versus 2023, I was doing an attribution analysis this morning. What outperformed in 2022 is underperforming in 2023. Mm-hmm. And what underperformed in 2022 is outperforming in 2023. So you should be real careful to, try to jump to the side of the ship that's catching a lot of fish. The reality is, if you keep trying to jump to the side of the boat where all the fish are, that the fish tend to swim to the other side of the boat. So you almost always underperform doing that. So to the best of our ability, that's what we should all try to do. I'm not saying I disagree with you, but I am saying that the market's been up, a good amount since October. So in theory, at least, you should be more cautious today than you were in October.
Yeah. So I don't know if I've ever asked you this question. So what do you think about, so there's market sentiment, bull bear sentiment, where people, as you were just talking about, have a view of the market favorably, unfavorably. What do you think about that contrarian view is usually the right view? I think that's what you're saying. So if there's a lot of people, if the market's roaring and everybody or most people are saying, get me in, the contrarian view to be more cautious is usually right. And if the market's suffering, going down and people saying, sell, 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 the contrarian view would be say, this is more than likely a favorable time to buy.
Yeah, it's interesting. JP Morgan has a great chart on this. When sentiment's really low, the forward returns are really high. When sentiment's really high, the forward returns, they're not negative, but they're not as nice, right? So that's just reinforcing, what I just said. But I think I think this all goes back to loss aversion, something that we all suffer from. People do not like having losses more than they like having gains. So this means if you go to a casino, losing $100 is going to feel a whole lot worse than winning $100. And this works in everyday life. This is one of the reasons why people hate inflation, by the way, because even if they're getting a raise, that more or less offsets the increase in rent or groceries.
Right.
The raises felt like a win, and the higher prices has felt like a loss, and we feel the losses more. And obviously that's not the same through every part of the country, and it affects everybody of different socioeconomic statuses differently, which also contributes. But I think generally speaking, that human nature is part of it. Additionally, I think people really struggle with price. And what do I mean by that? I think people generally understand that if things are stable and companies are earning money, the market will go up. But that's not always true in a vacuum. I mean, that might be true in a vacuum, but we don't live in a vacuum, right?
Yeah,
There's
the reality doesn't always play that way.
Going on, right? And I often hear people say, let's wait till things settle down. Things are really crazy and uncertain.
That's a real common statement. I hear that all the time.
When have things been certain? I mean, it's really, we have elections in this country every 2 years. Half the country is vehemently opposed to the other half of the country. And
they're always, it is always the most important election of our history.
Right. So, at least and campaigns last at least 9 months to a year, right? Better than anybody. Just given there, you're down to down to 2 years, every 4 years, where we could quote unquote be stable, right? Then you got interest rates, you got earnings, you got banking crises, you got wars, you got geopolitical conflicts. We've had you have pandemics. There's all sorts of things that can affect your investments. And the one thing that's true is, the stock market has done nothing but march from the bottom left to the bottom right in the chart over long term.
Right.
So, you can say you're going to wait and wait and wait, and you're probably just going to miss out on a whole bunch of returns. And I've seen this quite recently with some people who, decided they didn't want to stay the course. Maybe they wanted to go to cash. Maybe they wanted to go to cash last fall, right? And they missed out on nice returns. They're missing out on a nice 5% that we've already realized across most of our strategies, in 2023 here so far. 3 to 6%, depending on, in as high as 9% on some of the more aggressive ones.
Right.
That's far surpassing cash. And, I understand that people don't want to take any risk, and that 5% on a 3-month T-bill is attractive, but I think it's short-term thinking, and I try to be allergic to short-term thinking.
Well,
I get more there than you really wanted, but
no, it's great. I always go back on that general comment. I always go back to I say famous, may not be famous to people, but it's famous to me. It's time in the market, not timing the market, that gets you where you want to be.
I don't think anything's more true.
Yeah,
I really don't. Right. I mean, the NASDAQ 100, what was it, down in 2022? 30%.
Yeah, 32, I think. Yeah.
But it's been the best performing, sector of the stock market or of any market for decades now. I mean, we're talking 2 decades, and in the last 10 years, it's up almost 400%. Yeah. The S&P 500 is only up 210%. So yeah, I'm not preaching just throw all your money in the NASDAQ 100 either. That's not appropriate for most people. And why is it not appropriate for most people? Because most people don't have the stomach or the ability to withstand a 30% drawdown, to lose a third of your value in one single year.
It is very individualized, and you have to work. My advice is you have to work with a financial planner to calculate your risk tolerance, talk about your dreams, your goals, your timeline, and make those decisions that's right for you and your family, and where you want to end up and how well you want to sleep at night. It's different for everybody. Brian, we're going to take a break. When we come back, let's talk about the corporate earnings that have been coming out. Stick with us. We'll be right back. Thanks for sticking with us. This is Jeff Perry sitting in for Chris Boyd this week. And we're going to continue our conversation in this hour with Brian Regan, who's our Chief Investment Officer at Asset Management Resources. And I'll just say now, if you like what you hear or you have questions about what you hear and you want more information about our firm, check us out at amrfinancial.com. We're all over the social media outlets: Facebook, Twitter, Instagram, LinkedIn, YouTube. Check us out. And you can call our office as well, 508-771-8900. We'd be happy to talk with you. And if there's a way that we can add value to your financial planning and investing, we'd love to talk to you about that. So, Brian, before the break, we were talking about a lot of things. I want to zone in for this segment and talking about corporate earnings. It's the end of April here, and a lot of earnings have been coming out this past week or two. Talk about anything you like, specific ones, or just a general comment. What's your impression when you've seen these earnings come across the news before and after the market opens each day?
Well, I want to talk, this week was big for some of the quote unquote mega cap tech stocks that got lumped in together, but they aren't necessarily all very similar. So, I want to talk about 3 specific companies. I want to talk about Microsoft. I want to talk about Alphabet, Google's parent company. And I want to talk about Meta, Facebook and Instagram's parent company. So Microsoft and Meta, just on the top, was very well received by the marketplace, and Alphabet was a little bit more lukewarm. I won't say it was cold, but it was lukewarm. Now Microsoft absolutely blew out all their numbers. Now, When I think about individual stocks, and I've written about this in an article called "Stop Relying on the PE Ratio." I encourage everybody to go read it if they want more detail. But the two most important things to me when you're valuing a stock are consistency and growth. So, what does that mean? Well, I'm willing to pay up for consistency and growth, right? If there's no consistency and there's no growth, A, I might not want the stock at all, or B, I want it to be a whole lot cheaper. Microsoft, on business news, it's the constant argument about how it's expensive, with no discussion about how the growth and the consistency might justify the expense. And what I see when I look at their financials is a company that is remarkably impressive at growing revenues and profitability over the long term. Over the last 10 years, they've grown revenue by 10% a year. That's going to be compounded over time. Gross profit by 9%, operating income by almost 12%, net income by almost 16%, and EPS by almost 15%. So that's a lot of growth. That's about 5 to 6% in earnings higher than the market. So you should expect a premium. And the consistency is also, very, very impressive. To give you some ideas of this year, for example, was expected to be, a down year, which, that's a tough bet to make when you're looking at consistent, really, for the last 6-7 years, really since Satya Nadella took over as CEO of double-digit growth. That was a bold bet. And a lot of market participants were making that bet. They were saying, a lot of the recession talk, a lot of pullback on
right. That's what I was saying.
A lot of that expectation. And what did they do? Well, they just blew out all the numbers. So a lot of this stuff was expected to have declining growth or flat growth. The biggest thing being their cloud business was up to almost 20% on a constant currency basis. From a revenue perspective, they were able to grow margins. They were able to raise the expectations. Basically across the board, and the stock has responded, wonderfully.
So that's that type of growth is, and I think you're implying it, but I'll just say what I think I'm hearing is exceptional in any times, but especially in a time, if we go back to our first segment and talking about GDP slowing down and companies in that indicating that they may be doing less spending, which might mean less capital spending or less employees or whatever. So I think that's probably why people had maybe muted expectations for a company like Microsoft, if they have a fear, if those same analysts are thinking that the economy is going to slow down and potentially a recession, that typically leads to reduced spending of products and services like Microsoft provides. Is that logical?
Yeah, you would think so, but I think that doesn't take into account Microsoft's business model too. They've really moved to a subscription model. This is almost become a must-have product rather than a nice-to-have from a cybersecurity perspective, work from home perspective. We as a firm operate mostly in the Microsoft cloud.
Sure.
On almost anything we do,
as most people do, right? It's kind of I hate to use the word monopoly, but it's almost everybody.
Yeah. So we talked about how GDP grew at 1.1% in the first quarter, and operating income for Microsoft grew 15%. So it's basically growing 15% faster than the overall economy.
That is impressive.
I think I'm willing to pay up for that stock, right? You'd be interested in that. Now, if they can repeat that over a long period of time, man, the compounding effect of that is, you'll get your money back a whole lot faster than the average market participant.
So I want to take you off on a tangent, as we typically do. When I was, I saw the earnings, I saw the stock price respond favorably, and at the same time, we have the Activision issue in the news where the UK, I believe it's the UK or the EU, I don't remember which one, is denying the purchase of Activision by Microsoft, and the Microsoft stock didn't seem to flinch on it.
Well, the acquiring company's stock usually goes down when they buy another company. And why is that? Well, most large acquisitions don't work out. So something to the tune like 70% are a bad idea. So
Right.
I know people seem to fall in love with it immediately, but years go by and people find out that this is a disaster.
Yeah, maybe. Yeah.
I think AT&T is really the poster child for that for the last 5 years.
For sure.
Right?
Yeah.
They love to take big swings, and it's usually ends up being disastrous. So there's that. There's no, the cash that was going to go out the door for Activision Blizzard is now can be used for buybacks. It can be used for reinvesting in the business. It can be used for incentivizing employees. I mean, all sorts of things that they can do to double down on their core business. Now, at the same time, if you look at, if I'm gonna pick on anything in Microsoft's earnings, it's that their more personal computing segment, which includes Xbox, was down 7%. It also includes Windows original equipment manufacturing too. So, what does that mean? It means that PCs are still down. PC expectations are still down, but I know that those numbers actually beat expectations. But it also means that Xbox isn't continuing to grow. And one of the ways that I'm sure that they were hoping to grow that segment,
sure,
is from buying Activision Blizzard. Now, I think one of the more interesting things is on the Activision Blizzard side, the stock wasn't hurt that much, which means the premium that Microsoft was going to pay for it wasn't viewed as that great.
Right.
And that was interesting. That was even more interesting for me to see. I was looking into buying Activision Blizzard for that purpose, really, to try to get some kind of arbitrage there. And my thought process was, if this goes through, great, and if it doesn't go through, also fine, because you shouldn't lose that much. It was trading around what the business was fairly valued. I didn't do it because I didn't think the upside was enough, and I thought the downside effect could be greater than
risk reward type analysis.
Yeah. So
Brian, you mentioned Google too. That they didn't hit the ball out of the park, so to speak.
So I want to talk about Google and Meta kind of separately from Microsoft. These companies get lumped in together, and I don't think it's fair. Microsoft is almost on an island. Microsoft and Apple are almost on an island to their own. And Amazon, Google, and Meta are a little bit more aligned. And why is that? Most of their revenue comes from advertising. That's not true for Amazon, but it is a big business. And Google makes their money from YouTube ads and Google search ads. Alphabet is under pressure because OpenAI and ChatGPT, which is controlled by Microsoft, is a big threat to their search business. There's just no doubt about it. I mean, I've used this product; it's incredible. It could do great things. It's not perfect by any stretch of the imagination.
No, and we're only on the edge of what it could be.
But from what I've seen and heard, Google hasn't introduced anything that's remotely comparable. Right. Presumably they have something, but we haven't seen it. I'm also a little skeptical that they have this other bets bucket in their financial statements, and it doesnn't seem like much has ever come out of that other bets segment, right? They bought YouTube. That was a very good purchase. But do they have the culture to drive real value out of those other bets? I don't know. They've put a lot of money into self-driving cars and this AI business that we haven't really seen anything of yet. So I think the market is rightfully a little bit more skeptical. And what did we see? Well, search continued to do well. Not as well, but it's continued to do well. Not as well as it had been doing. YouTube ads were actually down. So that's the bulk of their revenue right there, right? So from search and YouTube ads. Cloud did well, which made up for some of the difference. But those are the two. I'd say that's the core business, the advertising business. And when you think about the advertising business, you can think about all the new competitors that have jumped into that business over the last few years, right?
And that's the type of sector that is always changing. At how people consume ads, how companies promote ads and deliver ads is something that's changed every decade. It seems like there's major changes.
Yeah, definitely. I mean, but we're definitely in the digital age. So if you think about digital advertising, you're going to go, advertisers are going to probably go to TikTok 1, Instagram 2, Facebook, Google 3, interchange Google search and Instagram probably, Facebook 4, and you can Amazon 5, and you could go down the list, right? There's a lot more options. It used to be Google and Facebook, and that was the game, right? Now TikTok was obviously a huge impact, and it looks like it might be taking share from things like YouTube, which might be further down on that list.
That makes sense, though. I mean, they're both video based, and if TikTok's doing it better, then sure.
Yeah, so that's the thing I am concerned about with Alphabet. I think it would be great if they could implement some of this supposed great AI technology that they have. I think all of these companies, from Amazon to Meta to Alphabet, are really struggling with headcount. At the end of Q1 of 2022, Alphabet had 164,000 employees. Now they have 191,000 employees.
Right.
That's a huge jump on a percentage basis year over year, right? Do they have, or how much are all these people working? Did they really have projects? When you think that they grew their headcount by, 20, 25%, and, what did their revenue do? It didn't grow by 20, 25%.
Didn't match that for sure.
Their ad revenue actually fell, and their total revenues grew by 1.5%. That math doesn't really work. And I think that's something that they're going to have to fix. Meta is in the same boat. So let's talk about Meta for a second. Meta made this. I'm a little jaded about Meta. I have a bone to pick with Mark Zuckerberg. Okay, he had this great
on the metaverse itself.
Yeah, so he had this great business with Facebook and Instagram, and
producing cash,
doing great. It hit a stumble because of some Apple privacy controls on phones.
Right.
And instead of focusing on fixing that, he changed the name of the company, said he was putting $30 billion or some number like that into the metaverse. Most people, I would say, thought that living inside a video game, was childish. I would say, not that it didn't have a market, but it definitely didn't have as big a market as Mark Zuckerberg thought at the time. Maybe it did.
Right.
He claims to still be prioritizing that. But if you look at his press release, I didn't see anything that said much about the metaverse in there, but I did see the key term AI, which is the new hot word of the moment. If you remember a couple of years ago, metaverse was the hot word. People were buying real estate in the metaverse. I had no idea what that meant, but it was hot.
I still don't know.
Still don't know. Still doesn't make any sense. Didn't make any sense then. Still doesn't make any sense. Now he's pushing on the AI button, which is great. But I didn't see anything. The market shot up with Meta on Thursday, which is great. Good for them. And it seems like they're dialing back a little bit on their spending plan.
That's what I was going to say.
Still planning on spending 26 to 30 billion in capital expenditures. The difference is they're starting to grow a little bit. So I think that pressure that they were getting from the Apple privacy issue is they figured out a solve in the short term. And I think Reels is doing better versus TikTok. So I think they're competing in their main space better, which if you told me that that's what they were going to concentrate on a year ago, instead of spending, all shareholder money on the metaverse, I would probably still be in the stock. So that's why I have a bone to pick with Mark Zuckerberg. But it's the company's fully owned by Mark Zuckerberg, and that is a governance issue, right?
It is. Yeah.
He did change course to some degree. I question how much of it is real. He says, quite honestly, on his conference call that he doesn't plan on pivoting from the metaverse too much. So, I do think personally, I think there's still huge question marks with this company. But the market seems to really like, at least that it looks like they're probably going to generate some 10% revenue growth from their main business this year. And when you're getting revenue growth, can offset a lot of spending sins. And the spending sins were definitely very, very, very clear when revenue growth was stagnating.
That's very insightful, Brian. I think Metaverse has heard the concerns and maybe shifting a little bit, cutting costs and getting focused on the primary business. And it's tough to walk back in such a short period the excitement that Zuckerberg had for the Metaverse. I think that might take time for him to get that more in focus and be more, or maybe less focused on the Metaverse. But right now we got to take a break. When we come back, I want to shift gears again. You wrote an article recently titled "Investors Beware: Celebrities and Companies Can Mislead You" that I very much enjoyed reading, and I don't think we've talked about it on the radio. So let's take a break, and we'll come back and get your perspectives on, should we trust these celebrities with all their endorsements and such? We'll be right back. Welcome back to Something More with Chris Boyd. I'm Jeff Perry, sitting in for Chris this week. And for our final segment, still have Brian Regan, our Chief Investment Officer, with us. Brian, you wrote this article that was, it's on our website, amrfinancial.com. You can read the article. I think it was originally published on TheStreet. Is that correct?
Yes.
Investors beware: celebrities and companies can mislead you. And the headline I got is an investment advisor is fed up with celebrity endorsements and rampant corporate misinformation burning investors. Here's his take on how to avoid the flames. That's a good lead in. So you write a lot.
I didn't write that part, by the way.
I know. You write a lot. Mostly about investing and your market outlook and complicated stuff. Then get published for other advisors to look at and people who are really deep in the weeds. What motivates? This is a little bit off for you, meaning the topic, right? It's more cultural, or I know it's got to do with investing, but it's got a tone of like, I'm frustrated, I need to vent. What's the motivation for talking about this stuff?
Yeah, that was 100% my motivation.
Okay.
I
came across that way.
Good. Because I am a little fed up with a lot of this stuff, and I didn't start writing it with celebrities in mind. Truthfully, I started writing it with, why is this stuff cropping up constantly lately? And I think as I started writing, the celebrity and influencer culture that we have started to become more clear to me that this is part of the reason, right? Whether it be through social media or paid tweets or Instagrams or whatever it is, right. This stuff gets propelled into
influencers,
culture,
right?
Yeah, a culture who is very influenced by influencers, for lack of a better word. And I think it all needs to stop. And if it's if my small voice can be heard, I think that's great. And yeah, it was driven by my frustration, but I do think of it as very much part of my job too. I think, one of the things as financial advisors that we can do, when we all talk about, low cost index funds and managing fees and picking good stocks and investing for the long term, and all that stuff is wonderful. I love it. But one of the best things that we could probably do is keep people from doing really silly stuff. And there has been no shortage of really silly stuff. So, I basically wrote what I preach to clients in private. I think a lot of this stuff is ridiculous. And I absolutely mean it. It's bologna sauce, right? You guys laugh at me whenever I say that. But
I was wondering if Armin had that on the.
It's my super nice way of saying something else that starts with the BS. So, we all need to be very wary of this. And
it's amazing to me that so Tom Brady.
If you bought a Tom Brady real estate, fan. What's that?
I'm a Tom Brady fan. If he's playing in New England, or if he's playing in Tampa, or if he's not playing anywhere, I'm a Tom Brady fan. What's amazing to me is not that Tom Brady was a paid endorser for cryptocurrency. That's not amazing to me because, like you said, we're in this period of influences where people who know nothing about things are talking about things. And what's amazing to me is that people listen. I mean, why would you listen? You can be a disciple of Tom Brady. I'm not at that level, but you can be a disciple of Tom Brady. Believe everything he does is right. But if he's on a commercial or on a social media post saying, that you should look into cryptocurrency, and I did, so you should. It's amazing to me that people take action and actually do that.
I'm with you, Jeff. I mean, on the football field, I'm an apostle of Tom Brady.
If he tells me how to throw the football, I'm going to listen, study, back it up, rewind it, and, that I'll believe. Right.
Tom, if you want to play catch, I'm available. But buying FTX cryptocurrency, I'm sorry, I'm you're not going to get me.
And it's not just Tom Brady. A couple of boxers were, right? A couple of fighters.
Yeah. I think I wrote about Floyd Mayweather Jr. I wrote about Bryce Harper. Talking about meme stocks, and I thought it was funny about Bryce Harper makes something to the 25 million plus more than the average household per year. And what's he doing influencing meme stock activity? He's not going to get burned by that. He makes more per plate appearance than I make in a year. So
and it's not like athletes have a stellar record of being great financial decision makers. I mean, the statistics on athletes are that most of them end up broke. And
great documentary called Broke.
Right. That's why I use the word. Yeah. I mean, it's just they live a different lifestyle for a while, and then they can't dial back, or they choose not to, or they don't do any planning, and most of them don't do. Well, some do very well. And sometimes they surprise you on who does very well and who doesn't, but you certainly can't rely on individuals who that don't have your best interest at heart and don't know anything about you and make decisions and rely on them for financial advice.
I also don't blame them for selling Dunkin' Donuts coffee or UGG shoes, or that stuff's fine. Get your money, do your thing. You're a celebrity, but pushing at best controversial assets, at quote unquote assets. I struggle to call them cryptocurrency assets, or pushing a meme stock craze that a lot of regular people got burned on. That is the definition of, it's not just unethical, it's immoral. Mm-hmm. And I feel like it's my duty to say something to that degree, so that people who either read, listen, or are my clients, understand that at least somebody that's in this professionally thinks this is a monstrously bad idea.
It would be very entertaining if a news reporter would get one of these celebrities, even Tom Brady, and ask them, could you explain what a meme stock is and why you buy it? Or can you explain the concept behind cryptocurrency? That they can't.
Well, nobody can.
Right. That's what I mean. But that they would fumble to it. Yeah. They would fumble through it. They're just paid endorses. And yeah. All right. So we agree. But it's just shocking to me that people fall for this stuff and see something. I guess it's not really that different it's different, but not much, when someone's watching CNBC and sees a commentator coming on, pumping a stock, meaning talking favorably about it, probably because they own it or they don't own it, depending on which way they're talking about it, and then going to their computer and saying, that sounded really good, I'm going to buy 500 shares of this stock because that guy sounded like he's right.
I think that's equally scary. Right. And it's not because I don't respect a lot of the people on CNBC.
No,
it's because everybody has a different risk tolerance, a different preference, a different time horizon. A lot of people are talking their own book, which is fine to a certain degree.
Meaning talking about stocks that they own.
If you are a high yield manager, for example, you're always going to like high yield. If you are a growth equity manager, you're usually always going to like growth stocks, or at least when you go on CNBC, you're not going to say, get out of growth stocks. That's your livelihood, right? And the reality is, if you're a growth equity manager and growth equity is getting killed in the moment, you actually might genuinely be excited, right? Because the prices are getting cheaper.
Right. Right.
But if person X gets in it and gets out of it a month later because it's going down, you unintentionally did a disservice for that person. So I think it's really important for people to do their own homework and have their own advisory. I think CNBC is great for sourcing ideas, though.
Right. As an initial,
I said
hey,
before,
here's
and
an
I'll say
idea,
again, I'm a
right?
CNBC fan.
Me too. But it's just, that sounds like a good idea. Let me talk to my advisor about it. Or if you make these decisions yourself, let me do my own homework, and that homework needs to be comprehensive and real, not just look up what the price to earnings ratio. Brian, we could talk about this for a half hour, but our time is up for this week. So thank you for joining me again. And I'm sure we'll have you on again soon. Great.
Thanks, guys.
Before we leave, I want to remind everyone about our upcoming Social Security and Medicare seminar. It's going to be live at the Marriott in Hyannis on Tuesday, June 6th from 9 to 11 a.m. We're going to have experts on Social Security and Medicare. It's one of our most, in my opinion, it's one of our most valuable things that we do for clients, is to answer these real life questions, either on a webinar or in person. This is an in-person seminar, but you do have to register if you'd like to go. No sales pitches, no fees. It's complimentary. We want you to learn about your Social Security choices, your Medicare choices, things that are coming up. If you have fears of Social Security going away, you can ask those questions. We'll have experts to answer those. It's really going to be worth your time, but you have to register to attend, and you can do that at amrfinancial.com. Once again, it is June 6th from 9 a.m. to 11 at the Courtyard by Marriott in Hyannis, and it's really going to be a valuable time, and I encourage you to attend if you're able to. Please tune in next week when Chris Boyd will be back in the big seat here, and perhaps I'll be co-hosting, and we'll be talking about all the things that have happened in the market, in the world of finances, and giving you our perspective on a variety of financial planning topics. We sincerely appreciate you listening. Have a good week, and keep striving for something more.
You're listening to Something More with Chris Boyd, Financial Talk Show.
Asset Management Resources, LLC, and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR, LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.